Uh, Hello again, everyone, and thank you all for coming tonight. Really appreciate it. I'll just do some quick introductions. So my name is Melissa Healy. I'm one of the directors here at Everills. This is Bob Chen, who's our senior financial planner and runs Everills Wealth Management. So he's here to provide some of the more detailed stuff on financial planning. So we'll share the presentation to you today. Let me know if I don't do this right. I don't have a lot of experience with microphones. I'm used to just yelling. Welcome to everybody online. We'll get started in just a second. I think we're just waiting on a few more people to join in. I'd like to introduce the team up the back to you as well. We've got Jason Griffiths, who's one of my co-directors, Grant, who's one of our senior managers, and Jared's one of our senior accountants. So they'll be available to ask questions of later on at the end of the night as well, and or just put up your hand if your drink needs a top up and they'll be more than happy to oblige. Okay, do you want to share screen? Welcome. Do you want to see drinks? There's some drinks. Sorry. Okay. And there you go. All right. I didn't do that. Did you do that? Back. Terrific. So welcome to today's presentation, pre-retirement planning. The idea is we are not talking about 2 or 3 years in advance. We're talking 5 or 10 years in advance, if not earlier. Certainly from our point of view, we want to talk to you nice and early to make sure that you're on track and have a really good strategy in place going forward. But we'll go through all of that with you tonight. As I mentioned, that's me and Bob. So I'm director in charge of all the tax, business services, everything. And Bob's our senior financial advisor from Everills Wealth Management. The fine print that I probably don't expect you to be able to read, but it is in your notes. The really important thing to note is that nothing we're presenting today takes into account your personal circumstances. This is all just facts about what you can and can't do. And therefore, it's really important that A, you get advice based on your personal circumstances. And of course, the second factor is there is no way we can consolidate all the fine print and rules, for example, contribution strategies and that kind of stuff in a 1-hour presentation. So we have generalized a lot of stuff here. You have to be really careful to make sure that if you want to do any of the strategies that you pay particular attention to the detail and double check before you go and implement anything, because there are things like age limits, contribution caps, all sorts of things that you have to watch out for. So please be very careful. Give us a call before you try and do anything. Is that close enough? Good. All right. 5 even. Okay, we're gonna get started. So tonight's agenda is fairly straightforward. We're going to talk to you about how much superannuation is enough. One of the major or the first things that financial planners need to talk to you about, or that you need to consider in your pre-retirement planning, is how much superannuation is enough. How much do you actually need to maintain your lifestyle in retirement? So when you know where you need to be, then the question is, well, where are you now, so that we can then develop a strategy to get you there. Okay. And in terms of those kinds of strategies, it's not just as simple as we'll contribute more to super or whatever. There's a combination of things that can be done to really fine tune and tweak your strategies and your personal circumstances to make the most. Because especially when you're talking about a strategy that's going to last, or a financial plan that's going to last 5 or 10 years, the compounding effect of even little changes, be that to your costs or your performance or your tax situation, all of those result in big differences at the end. So it's a lot of little things that will get you to where you want to be. So tonight we'll mention some stuff about maximising your super, minimising your tax, getting your debt paid off as fast as possible, asset protection strategies, because of course there's no point building all this wealth if accidents happen, kind of thing. Insurance is an important aspect to make sure that you're protected in your lead up to retirement and beyond. And of course, unfortunately, estate planning is one of those inevitable things of life and taxes. So we'll be talking about all those kinds of issues. Because we've got a nice cozy group today, and not quite sure how we'll juggle onliners, but Leanne will probably text me to let me know if there's any queries on that front. But you are welcome to raise your hand and ask any questions as we go along. It's much better if I'm not explaining something properly, that you ask straight up and then we get it resolved, because I can guarantee that if you're struggling to understand something, there'll definitely be somebody else as well. Okay, so don't be shy in putting your hand up. Okay, so let's have a closer look at how much do you need. Do you guys have a rough understanding of how much you think you're going to need, or are you still a bit curious as to how much life is going to cost in retirement and all that kind of stuff? Okay, let's have a look. The question, of course, is that it depends on what your designed lifestyle is going to be. The other things that you can take, and we'll be talking about these in a bit more detail, but how long is your money going to have to last for as well? Some of that's genetic related, but the important thing here is to note that life expectancies these days, and when you take into account medical science and all the rest of it, that most people have a life expectancy of about 85 to 90. And that means that if you're retiring at age 60, you really do need to budget on 30 to 40 years, so-called in retirement. So making sure that your money's working hard for you, and generating an income stream for you for that long is quite important. And then, of course, one of the other questions that comes up is, well, or the determining factors is, well, how much do you want to leave as a legacy to your family? There is one strategy where you start with a balance in your super fund, and the idea is that by the time you've passed away, there's nothing left. It's the ski principle, spend the kids' inheritance. Or, of course, if you want to preserve your capital or leave a particular amount of money for kids, or a particular asset for kids, then we need to bear that in mind, that capital is not available for funding living expenses, and we actually need to preserve that. So, yeah, the big question is therefore going to be how you're going to protect and grow your superannuation going forward. The four main elements when you're actually trying to work out how much money you need to live on, you're going to need to sort of work out what your reasonable living expenses are, and later on bearing in mind the fact that you might need some aged care assistance. You can, I know my kids learnt in school the difference between wants and needs. So the reasonable living expenses is what you need to live on. The extra lifestyle income is designed to cover all those extra things that you want, like some extra travel or some nice travel, hobbies. Outsourcing means being able to pay for a cleaning lady and a gardener and that kind of thing. Okay, so those are things that you could live without if you had to, but we'd much prefer not to have to live without those. So we want to try and build that in as well. When we, as financial planners, when we talk to clients, we need to work out if there's any extra one-off spending. So a lot of people want to retire and do up the house a bit, or maybe we need to budget on the fact that at a certain point in time, maybe it's 5 years into retirement or something, your car's going to need upgrading, that kind of thing. Or maybe you've got some travel aspirations in these days. That's a bit of an ask, but you know, a lot of people will do their 3 months overseas, that kind of thing. So we want to budget that kind of one-off expense, or maybe it's a big overseas trip every 3 years, that kind of thing. So we're going to try and build all of that into it. And then, of course, as mentioned before, the legacy idea, or having spare money to be able to help family or charities, that kind of things. But you know, some of those can be quite expensive, or maybe it's at a further point down the track that you want to help a kid with, whether it's weddings or you know, a deposit on a house, that kind of thing. So making allowances up front for that kind of expenditure. So the idea is we'll sort of say, right, well, you know, reasonable living expenses and extra living expenses, those add up to so much per year. And then we have to add on the fact that we've also got these extra expenses that'll be popping up from time to time. And then based on a forecasted rate of return, we'll then be able to work backwards to work out how much you need. But let's have a look at that in a bit more detail. This is what's called the longevity curve. And the point here is you need to bear in mind that the first 3/4 of your retirement are going to be pretty good. You know, you're going to still be active. You're going to be able to go on your holidays and do things, and therefore you're going to need money to be able to do that. Then in your last little bit, that's where you're going to have your activity limitation. And this is where it gets hard to forecast. You're going to be spending less. So, for example, you might be happy to be at home with the grandkids or something, versus depending on how things are going, maybe you need a little bit more aged care support, that kind of thing. So that's where the budgeting works out a little bit different. This graph explains it a little bit better in terms of when you first retire at sort of age 55, you're spending, you know, you're having fun, you've renovated your kitchen and you've done your big cruise, you help the kids with the mortgage, so your expenditure's quite high. But then as time progresses and you've done all of those bits and pieces, you settle down, you're just doing maintenance on the house, everything, you know, looking after the grandkids, not doing anything terribly exciting. And so your expenditure sort of bottoms out a little bit. But then, of course, as you progress in your age bracket, that's maybe when you've got some increasing health costs and or some aged care expenses. So this is where we've got to be careful with how we budget for what your minimum pension payments kind of thing need to be able to support that kind of lifestyle or living expenses. If you're wondering what most people need, this might interest you. So, for example, and this is again where we've split it between when you're 65 and when you're 85. Now, these are the stats from the ASFA retirement standard back in just in March this year, so they're relatively up to date. What you can see, though, is that it doesn't really make a lot of difference. So before, where we had a big dip in the graph, in reality, it's only a few grand difference between age 65 and 85, because as you spend less on other stuff, you'll spend more on medical expenses, apparently. But yeah, these modest lifestyles really are very modest. They are only barely just above the age pension amount of money that you can get. So, you know, we definitely don't aspire to be down here. But yeah, as a single person, somewhere between, well, you know, high 20,000s is apparently all you need. That's not going to get you very far at all these days. Bearing in mind that this is tax-free income too, and you'll probably be eligible for some other benefits like the healthcare cards and things like that. As a couple, because it's still the one house, one set of rates, one electricity bill, that kind of thing, it doesn't actually increase dramatically, obviously twice as much food, but we've got some bulk discount, if you like. So we're looking at perhaps spending 38 to 40 grand a year. Now, when you want the slightly more comfortable lifestyle, then again, it just jumps a little bit compared to before. But in reality, we certainly find that most of our clients are trying to target a fraction more than that, given the income that they're coming off. They have a lifestyle to which they've become accustomed, shall we say. So, as I said, as a last resort, your age pension will guarantee you the first 25 grand or the first 37 grand as a age pensioner. These days, the age pension doesn't really start until 67, although if you're that old already, you might be eligible for it from the old 65 date. But you do have to watch out that it is subject to an income and assets test. Okay. But you do get those other benefits through your pensioner concession card. So that's your base level support. Then you go to that modest and comfortable side of things, which is the examples that they give in the standard there are, it's the difference between eating at home versus the occasional takeaway versus nice restaurants kind of thing. It's that kind of, and holidays and no holidays, a trip down the coast versus a nice holiday somewhere else, that kind of thing. Based on those stats through that financial standard, what they're talking about is that to generate that amount of income, you need to have lump sums, or the total superannuation balance or investments that you've got for couples and singles, 545 versus 640. Okay. So if your superannuation isn't that high yet, so we were talking before about, step number 1 will be to work out or how much you need. Step number 2 is to work out where you are now so that you can work out how to fill in that gap. All right. And what we've noted down here is that for your modest lifestyle, you only need $70,000 apparently in other assets, for example, superannuation, because your age pension will kick in and provide you that first $27,000 worth of income. But as we said, that's only if you're at last resort. In terms of how much is really enough, we certainly find that, statistics do show that the average level of spending is actually closer to 92 grand. So maybe that means people are actually chewing into their capital, or maybe there's some other, higher net wealth individuals out there. But median level of spending about the 75 grand a year. So it's definitely more than those comfortable even, so not even just modest, but even more than the comfortable lifestyle. This is what you more than likely should be trying to target. And the interesting thing is that 30% of SMSFs plan to spend over 100 grand a year. So for people who are coming off a salary of, 150 grand a year or whatever your average public service rates are or something, admittedly, this is all tax-free. So whereas while you're earning, you've got to pay tax and you have a reasonable amount of expenses still happening. But SMSF kind of people are still targeting about the 100 grand. And certainly from our Everill's wealth management strategy, if we can get to clients early enough, so to speak, we really want to help you target that $100,000. So the way you work backwards is that, for example, $2 million in a super fund, or between the two of you, if you're lucky enough that way, we budget on a 5% pension. So the government has minimum pension limits that you have to take when you're in pension phase. So $2 million at that minimum 5% pension for, say, a 65-year-old means that you're going to be getting the 100 grand a year to live on. Okay, so that's how you work backwards. Now, the reason what we're actually going to target is a rate of return of 7% on your investments, so that there's 5% of that to pay out to you guys as your pension during the year. And we're keeping 2% in the fund for capital growth purposes to keep up with inflation. Okay, so so your balance of your fund goes up by 2% every year. So 7% goes in, 5% comes out, 2% stays in the fund, and that builds the capital up over time to maintain inflation, protect you from inflation. So that the following year you get 5% of 2 million plus the 2% kind of thing. Make sense? So the 7% needs to be net return after fees. because, yeah, we're going to pay out 5 and we want to keep 2. So all of the costs have to have already come out before we get to the 7%. Yeah. Okay. Now, as some of you will be aware, some of the super funds took a bit of a hit last year, and they certainly did during the GFC. But what the government has therefore done to take into account challenges that funds might be facing generating enough money to pay the 5%, they've actually reduced that to 50%. So the minimum pensions for the last 2 years has been 2.5% per year, not the 5%. That's fine if you had spare money to live on, but not if you needed the cash. Yep.
Last year return was over 20%. And so the COVID really didn't, bring the balance down. Previous year, the medium return was 0.5%. So nobody lost any money. So in fact, the biggest growth came from last 12 months because there's so much money have flowed into the market from the governments, from stimulation to the economy. So it's a good thing that, you don't have to pay out a lot and keep the money in the tax-free.
Thank you. Yeah. So, correct. Yeah. Okay. So that's now, I mean, I know $2 million does sound a lot, but the idea is if you bear in mind that your money doubles every 10 years, 7 to 10 odd years, depending on how many GFCs or COVIDs you have in between. But the idea, and if you look at some of the investment strategies that we're talking about, with discipline and a proper savings plan and all the rest of it, this isn't necessarily that hard to achieve. And even if that is a little bit beyond your wildest dreams, that's okay. At least we can, there's still plenty of stuff that we can do to maximize whatever you've got. Okay. So, everybody's an individual, but we're just sort of saying this is definitely what's possible for some people. So that gives you an indication of how much money you might want to consider, both from a lump sum point of view and or a living expenses point of view. If you want to, for example, go home, have a look at your current budget. If you're able to retire debt-free, then you don't have mortgage repayments to go. Maybe the kids will have finished school. Maybe your house renovations are finished, all that kind of stuff. So there'll be a whole stack of things that you won't have to pay for anymore. But, try and work out from that based on, house expenses and or what you normally spend your discretionary money on. That'll give you an idea of perhaps how much money you need to live on in retirement. But that'll let you know, that those figures up there will let you know whether you're in the ballpark or not, or whether you've probably forgotten something. Okay, so when we know where you want to be, the next step is to work out where you are now. Lifestyle assets. How many of you have read Rich Dad, Poor Dad? Okay. Yeah. Exactly. The classic line in that a car is not an asset, it's a liability. But anyway, so lifestyle assets such as your home and car, the question is, so for example, with your house, are you actually going to be planning on downsizing? You've got the big family home now, but when you retire, depending on your either financial circumstances or perhaps even health in terms of maintaining gardens and renovating stuff and all the rest of it, is your home going to be available to sell so that you can downsize into something more low maintenance, or is it something you're actually going to have to spend money on maintaining, and now that you've finally got time, you're going to renovate the kitchen and it's actually going to cost you money, so to speak. Cars, yeah, just bear in mind, right, well, what sort of car do you like? How often are you going to have to or would like to upgrade it? That kind of thing. But basically lifestyle assets, we're otherwise not really taking those into account, because if you're not planning on selling your home, it doesn't matter whether it's a $500,000 house or a $5 million house. It's not going to help your day-to-day living expenses at all, other than perhaps having to bear in mind how much your rates and electricity bills are. So the important ones are obviously your investment assets. So that's everything from your rental properties, your shares, your superannuation, all that kind of stuff. Fairly obvious. Debt. Okay, we'll be talking more in detail later on about how normally, what we're saying, that the top 3 goals of anybody includes being able to retire debt-free. The last thing you want is to have to be paying mortgage repayments out of your pension. Okay, that's going to make a nasty dent in it. So again, one of those strategies that a financial planner can help you with is working out ways to get that debt paid off faster. When we're talking good debt and bad debt, that's all about, good debt is to buy investments. Bad debt is non-deductible debt on your house, for example, that you're not getting a deduction for, and worse still, things like credit cards. So hopefully all of you are paying them off every month. And last but not least, just double checking your insurances and your estate planning. Not a fun topic, but you do need to make sure that you are protected and your family is protected if something goes wrong. We're also finding, we're a 53-year-old company now, and we have a lot of mature clients, shall we say. And unfortunately, at least not so much this year, but I think last year we had a really bad run where we had about 3 or 4 clients lose mental capacity. And, if you don't have a power of attorney in place to be able to look after your finances for you, or at least, help keep an eye on things and make sure you don't do anything silly, that's important. So the where are you now is fairly straightforward. Some clients are a bit more complicated than others, but as I said, the trick is to work out where you are now versus where you want to be, so that we can then come up with strategies for you in between to get you there. So in terms of strategies to get you there, Tunza. Okay, what we're going to talk to you briefly about tonight, given that we've only got an hour, I've got a lot on maximising your superannuation, because obviously that's so tax effective that you'd be nuts not to try and maximise your superannuation. Okay, we're going to throw in some quick discussion about tax minimisation. Every penny helps. So, and especially, if we can save you a little bit of tax every year for 10 years, that's going to add up by the end of it. As I mentioned, we'll talk about debt reduction and asset protection, personal insurances and estate planning. So, maximising your super. Does everyone know what an account-based pension is, or what different types of superannuation there are? Okay, so this is Canberra. We're in a public service town. The people who have the CSS or even some of the PSS defined benefit funds, military super as well. Defined benefit means there isn't basically a pool of money that's been contributed for you over the years. The government just guarantees to pay you a benefit of a pension of X per year, and it's automatically indexed for inflation. Really nice. Hang on to those at all cost. An account-based pension is more your normal superannuation fund, where the bosses put money in, you've put money in, investment earnings have gone in, and it's sitting there in accumulation phase at the moment, just growing. And then when you retire, we flip that accumulation account into a pension account, and then it starts paying you money. Okay, so the problem is with account-based pensions, the balance goes up and down depending on the value of the underlying assets, whereas with a defined benefit fund, it doesn't matter what the economy has done, the government still guarantees to give you your same pension every year. Okay, but the point here is that your SGC really isn't enough. When SGC was first introduced, back in the 80s, late 80s, at 3%. It was always forecast to go to 12%. Now, various governments over the years have delayed, for whatever reason, e.g. GFC, etc., the implementation of the annual indexing. But this year, for example, we have gone from 9.5 to 10% now. So it's a nice round amount. So we're going to look at that and 10 ways that you can contribute to super tax effectively to try and top that up. If I can also say, in the old days, so to speak, must be fast approaching 10 years ago now, where you remember reasonable benefit limits and all that kind of stuff. People would have, this is when tax rates were like 60%. So everybody had a rental property. They were negatively gearing it to get their personal taxable incomes down. Then they'd wait until retirement. They'd sell the rental property, and then they'd chuck however many hundreds of thousands of dollars into their super fund as a last minute thing, or they downsize their house, take the cash, get an inheritance, throw a whole heap of cash into their super fund. So in the old days, super really was a last minute event. These days, because we've got contribution cap limits and because Howard made superannuation for anyone over 60 basically tax-free, it's not sustainable, but they couldn't reverse John Howard making it all tax-free. So that's why they've now introduced things like the pension transfer balance cap and the total super balances, the 1.6, now $1.7 million. So the government's sort of solved that now by limiting how much money you can put in. And because that's done via annual contribution limits, the strategy here is slow and steady wins the race, because you won't be able to put in the big lump sums at the end. So maximising these along the way. And again, this is why we want 10 years to be able to talk to you before you retire. So when it comes to maximising your super, particularly in those account-based pensions, that capital value depends on your underlying asset investments. So you do need to get help to make sure that you're invested correctly. If nothing else, check whether you're in a conservative fund, a balanced fund, or a growth fund, or even an aggressive fund. Okay, make sure that what your underlying investments are invested in suits your risk profile so that you can sleep at night and you're not taking any unnecessary risks. You do, as we said before, have to understand that the balance of your account is going to go up and down. But the big thing is that income stream is tax-free after age 60, thanks to John Howard. Okay, so it really makes sense. Why would you have investments in your own name if you're paying tax? Because you could have it via super and you get your super pension and it's tax-free. You don't even have to put it in your tax return. Okay. And the other brilliant thing is that, so while you're accumulating money in your super fund, still working, and boss is putting money in, you're putting money in, investment earnings are going in, you're only paying tax on that at 15%, whereas perhaps your marginal tax rate is 34, 37, 47%. Super's only getting taxed at 15%. And then when you flip it from an accumulation phase into a pension phase, and you start taking money out, then all of those investment earnings inside the super fund, they're also tax-free, as well as the pension that goes to you. So as I said, it's a no-brainer. You have to maximise your superannuation. Okay. Don't get mixed up with the age that you can access the government's old age pension. That was the 65 to 67, whereas superannuation you can access from 55 to 60, depending on your birthday. Okay, if you're younger than 50, it's definitely 60. Okay, but it phases in, a half a year for every 18 months period. So there's a table, it's easy to look up and work out. But the good news, though, is that there are also transition to retirement pensions. So once you have hit the super accessible age, you don't even have to have retired. They introduced those transition to retirement pensions so that people who wanted to progressively go part-time, didn't want to go cold turkey, so to speak, on their employment, and just wanted to keep working a little bit, they can do that and still access some pension to top them up. There's special rules about those and the minimum and maximums that you can take out, that kind of thing. I think this just expands a little bit on what we were talking about before. So you can see here on, is that the left-hand side? Yeah, left-hand side, how much capital you've got in your fund. And then these are the minimum pension payments. So when you're 60 to 64 pension phase, you have to take out 4% of the fund. When you hit 65, you have to take out a minimum of 5%. When you hit 75, you have to take out a minimum of 6%. So this is the government's idea of making you progressively use up your super. And there's no maximum. Okay, so once you've hit the retirement age, accessible age, and you are retired, there's no maximum. Or once you've hit 65, there's no maximum that you can't take out. Can take out anyway. There's no maximum. But this is where we're talking about that $2 million. If you're 65, 5% pension, that's the one that gives you your 100 grand a year. If you've got a different amount in here or a different age bracket, that'll tell you roughly what you can take. Okay. And of course, you can take more. As I said, this is the minimum. If you take more, that's okay, but you might be chewing into your capital. We've got a client who came to us a few years ago and said, this is the balance of my fund. I'm retiring at age 65 and I want to draw out X so that it's all gone by the time I'm age 80. So, there's no capital left on that one. And that's okay. They've got other resources. Then they'll start using something else to fund their living expenses. But, everybody has their own strategy. Okay. And sorry, I think that's important too to understand. So before, when we said, you need 2 million to live on to get the 100 grand, or even if you don't have that much money up front to generate that without touching your capital, you can still fund your living expenses. So it's not like you have to live like a pauper. You definitely can take out more. It just means that there'll be less left at the end. Okay, but maybe that's then at the end where you do rely on some other sources, or just accept the fact that you won't be doing the overseas holidays anymore. Okay. In terms of topping up your superannuation, and again, this is why we want to talk to you early. If you're 30 years old with earnings of 80 grand a year, you'll actually earn about $536,000 worth of super between now and retirement. So you remember that table that said the standards say you need $640,000 as a couple, or 580 or whatever it was as a single. So the idea here is that if you're only 30 years old, you only need to top up your super by a whole whopping $124 per year to be able to hit that comfortable lifestyle retirement. Okay. But if you're already 50 years old, you're actually going to have to top up your super by $16,000 a year over the next 17 years rather than 37 years. Okay. So this is where it's really important to start early, working out exactly what you want in retirement and that strategy to get there. Now, we're also realists in terms of, when you're 30 years old, you're probably trying to pay off your house or pay kids' school fees, that kind of thing. But, you have to know what your plan is. And if it's possible to chip in that little bit more earlier on, it will have big benefits because that'll be less that you have to do later. And this is, again, just a bit of a table based on your current earnings. So, if you're 120 grand a year now and you're already 50, you got to top it up by 13 grand a year. Okay. To get to that 545. All right. I'm just going to run very quickly through 10 different ways you can boost your super through extra contributions. Okay, I'm not doing this in detail because our next boardroom briefing next month on about the 17th of August, we're going to go through all of this in a bit more detail. Okay, so you're welcome to join us in-house or online again for that one. I don't think, so I'll just run off this. So employer contributions, that's your SGC. Okay. So as I said, the government now has to put in, your employer now has to put in at least 10%. Public servants are getting 15.4. But that's your contributions there. Your employer also pays the salary sacrifice contributions. It's just that, that's your money that you've told the boss to don't give it to me as pay, put it into my super fund for me. That's very tax effective because instead of you earning that money and having to pay 37% tax on it, maybe 47% tax on it, it'll go into the super fund. Your employer will put it in the super fund for you and it only gets taxed at 15%. These days, you're also allowed to top up the superannuation yourself with personal contributions that you then claim in your personal tax return. The thing to watch out for is that the total of your employer contributions, salary sacrifice contributions, and those personal concessional contributions, the maximum last year was 25 grand each per person. This year, it's going to be 27,500. It finally got indexed. Okay. And a couple of years ago, they introduced these catch-up contributions. So if you haven't been able to maximise your contributions through salary sacrifice or personal contributions, so maybe you've only been putting in 15 grand a year instead of 25 grand a year, that extra 10 grand can carry forward so that you can pay, for example, $35,000, which is this year's, well, 27,500, and then 10 grand-ish is catching up previous year's contribution. So, but again, there's rules. It's only really applicable to the people who've got less than $500,000 in their super fund. If you've got more than that, the ATO says bad luck, you can't catch up. So again, really important to watch your super fund balances, and it's your super fund balance at 30th of June the year before. So just got to watch that. If you can't make any tax deductible contributions, then you're still able to make contributions. It's just that they're non-tax deductible. So you'll earn your salary or you'll have your savings. You'll have already paid your tax on it. If you want to chuck that in your super fund, go for it. And definitely, as I mentioned before, a good idea, because the earnings only get taxed 15% in the super fund, whereas if you earn the investment income in your own name, maybe you're paying 34, 37, 47% on it. Okay, so very tax effective as well. For our low income earners, there is the government co-contribution that if you put in, for example, $1,000, they'll put $500 into your super fund. So, but again, income, age kind of limits and where you get your income from. So again, before you go putting your $1,000 in your fund, just make sure you are eligible for that. But very handy. Got a spouse that doesn't work, for example. Spouse contributions, awesome way to get an 18% rate of return. So you make a $3,000, if your spouse is low income, you contribute $3,000 into their super fund and you get to claim a rebate, an 18% tax rebate in your tax return. So you get a $540 tax credit in your own personal tax return for putting $3 grand into your spouse's return. Okay, but remember, age limits, work tests and all that kind of stuff. Spouse super splitting is one that's becoming more and more popular now that we've got these transfer balance caps and maximum pensions and total super balance limits and all the rest of it. So what that means is that your boss puts the 15% or maybe the whole 27,500 into your fund during the year. At the end of the year, you then send a notice to your super fund saying, I know you've taken 15% tax out, but the other 85% that's sitting in my super fund, can you please transfer that to my spouse's account? And that way you can even up the accounts, which is really good. So I had one client a couple of weeks ago, military. He's already hitting, and he's a few years off retirement, but he's already hitting his 1.6. So there's no point. You only get the tax concessions on the first 1.6, so there's no point building up his superannuation anymore. So his employer money goes in during the year, and then come July, we tell the super fund to move that across to his wife's account so that she is able to accumulate that money and then eventually draw a tax-free pension on it, whereas he wouldn't have got a tax-free pension. Okay, so that's a really good strategy. Again, lots of fine print, lots of rules, lots of forms to fill in, but that's available. Downsizer contributions, the tax office just dropped the limit on this, but these are really, if you qualify, it's a brilliant way of getting some extra money into super because it's a totally separate, like there's no caps involved. So even if you've got $2 million in your fund, if you sell your house that's been your house for the last 10 years, that kind of thing, then you can contribute $300,000 each, which is $600,000 between a couple. Into your super fund as a downsizer contribution. So brilliant way of topping it up and getting money into super, even though you've maxed it out on all the other caps. Okay, but again, watch the fine print, watch the dates, watch the timing. You've got 90 days to move your money across, that kind of thing after settlement. And last but not least, small business CGT concessions for those of you who are running businesses. Maximising the value of your business and ensuring a effective sale of it at the end and crystallising some capital gains out of that sale of goodwill, that can basically go into your super fund tax-free as well. So, and separate caps and all of that, but there are age limits, so don't leave your run too late. So, and we also do a lot of work with clients, so that's only for businesses worth up to, or let's just call it $6 million net assets kind of thing in the group. So we actually do a lot of restructuring of clients who are starting to approach that limit, don't want to sell the business, but then we'll restructure it so that we can crystallise the capital gains tax-free up to that point. And then from then on, they only have to pay tax on the profit above that. So again, if any of you are business people, make sure you have a chat to us about those kinds of strategies. But please, fine print. You have to be really, really careful. Don't go home writing checks. You have to check your fine print on your age limits, your work test, okay, to be able to contribute money into super, total super balance caps, all that kind of stuff. There's a lot of fine print these days. Not simple supers rubbish. It's very, very complicated. So be careful, and or come to our next boardroom briefing for a bit more information on that kind of stuff. Now, there's just some of the fine print for you. So as I said, 10%, the caps at the moment, various limits. So yeah, please be very, very careful. On that note, I think that's enough from me. So I'm going to hand over to Bob to do all the strategy. Keep it right up top. And just scroll one at a time.
Yeah. Now you got all the money contributed to the super fund. I think it pays to pay attention to see how your super fund is performing. You'll be surprised to know how many super funds are in Australia. Anyone knows? 500. That's a lot of them. Industry fund and retail funds and so on. And the performance make a big difference to your money. And the difference just been researched by Productivity Commission from inquiry reports. This came out in 2018. The difference between top quartile to the bottom quartile of your fund, it would be 635,000. That's a significant sum. And obviously, if you want to double your money, it's a 10% return, it's 7 years. But if you're doing 7%, it's going to take you 10 years to get there. I think as a financial professional, we always tell people the past performance is no indication of the future. You probably heard that before. And I have to disagree with that because based on what we find, a fund consistently performing, consistency, past performance together, it will give you a better indication what they will do. The fund is doing well, it's always going to do well. The fund in the bottom quartile, it's probably not much chance of next year they're going to do well. So clarity about how your fund is doing is come from independent research. We also do the comparison to make sure you're not in the bottom quartile fund. There's a few other things we need to look at, about your super fund. One of the key things we need to look at is to understand you can't afford to lose, right? You're no longer contributing to the fund, you're no longer working. So the money is going to last for 30 years. So what's important to you to ensure that 30 years, it's protected is you got to have an investment philosophy. Investment philosophy started from risk management. So how do you protect your money? So what kind of risks are you exposed yourself to? And let's refer to Warren Buffett, which basically saying never lose your money. And number 2 rule is not to forget the first one. And we just take this quite seriously. This is a sample of the type of risk we look at. And the first risk is sequential risk. Say if you have $1 million, you retire, let's say 2 million. And then here comes GFC, right? You drop 30%, you become 1.4. Your retirement, it's just gone, right? Because you have no time to recover, you're not contributing, and you have to protect that. But if the GFC came 10 years later, you'll be okay. Because, before that 10 years, you would have grown your fund to take that hit. So when you take a hit, it's really, really important. Market risk, obviously we saw COVID and we saw GFC. Basically every 7 years, it's a bear market. So bear market, 20% drop. Every year you have a correction. Correction is 10%. So the market risk is always there. To deal with that, you have to make sure your investment is top quartile. It's the top performing, but you also want to diversify, not to put all your egg in one basket. So sometimes, I say some of the portfolios have extreme exposure to Australian equity. So that's a bit of risk there. Inflation, how do I describe inflation? I think I look at the numbers back in the 70s. I'm not that old, but if I look at the data, and in Canberra was 70,000, right? What do you pay now? So, I have people saying to me, you can't buy much for $1 million. So that's inflation. Inflation comes from supply of money. So the government are printing them. So the same thing, where did the government get $160 billion to pay for the cost? Nowadays they don't print them anymore. It's a figure to type into the computer. So everything gets more expensive. So inflation is important if you think long term. So your portfolio has to deliver that extra 2% minimum or even higher, so that in 30 years' time, you still have the same amount of purchasing power of today. Longevity, I'm an optimist. I plan for 100 years. And that's, if you look at the Bureau of Statistics, the life now it's 88 years for women. We generally add another 5 years, will take you to 93 and even beyond that. It's a better way to look at your finance is to make sure your capital doesn't drop. And I often say to people, they say, it's not good feeling when it goes down each year. So that's not quality living. So you want your money slightly goes up, your income comes in, so you can live and enjoy. So that's really dealing with the emotional risk. Emotional risk is about to be free from fear, to be free from greed. So it works, you have investment sort of philosophy, you have an investment plan in place, and you're not worried about the market. You're not worried about the drawdown, you're not worried about the risk, you can sleep in the night. Now, one of the things is, out of those 500 super funds out there, a lot of them being around for a long time, right? They charge a lot of money. One of the research on Morningstar have identified the key contributor to your performance is actually cost. So there's an industry funds, you probably saw the ads, two lifts, and one pays less and another pays lots. And the difference to your balance is quite significant. And we're not talking about small changes here. We're talking some fund will charge you 0.6%, some fund will charge you 2%. So if you are in an expensive fund, you need to know about it, and because that's damaging your retirement planning. One of the things people didn't look at is insurance in the super fund. And as you get to about 50 years old or beyond, the costs just skyrocket. But because it's not coming out of your credit cards or your bank account, a lot of people have not paid the attention to what the true costs to them are. So often I see people having incredible amount of money being taken away from the retirement because the insurance gone to 10, 20,000 a year. So that's something you need to pay attention to, reduce the cost for your super fund. Okay. Did I miss anything? Oh, tax minimization. How exciting. Tax minimization, and one of the key vehicle for tax minimization is your superannuation. I think Melissa already talked about this tax being a tax firm and financial planning firm. There's no other better vehicle unless you want to run a charity. So the tax. So there's a lot in terms of minimizing from climbing tax deduction to into your super. More, okay. From the capital gain tax perspective, is if you're lucky enough to bought property, if you have a capital gain in your super fund, there's a strategy to minimize that. So the way to look at the capital gain tax is once you hold it, the investment for more than 12 months, your tax rate is 23.5%. The reason why for that is you get a 50% discount. So that's a lot cheaper, less than your PAYG income. And if you got a capital gain tax, and there's many different strategy can minimize that capital gain further by moving money, distributing money, using different vehicles. So that's what we talk about trust in company. You can also create a deduction through negative gearing. I'm not a fan of it, but at an early stage of your life, if you want to
buy into property, you want to buy into shares, you borrow to invest. When you do borrow, the interest is tax deductible. So that helps you to accumulate more wealth. Sorry, I'm not used to the, it's not responding. The battery runs out. It's just like, yeah. Melissa already said that by the time of retirement, you should really pay all your debt off, right? So data reduction is really important to look at your mortgage. In my opinion, in a lot of cases about debt reduction is to do with the behavior. It's to do about saving your money. You should do that as early as you can. If you don't have a debt, you have a lot of money, you have a lot of strategy option to direct the money into your super fund or start building personal wealth. So paying off the debt, it's quite important to do that as early as you can. And without the debt, you have a surplus cash to do a lot of strategy that a lot of people don't have option for that. So we're talking about data reduction from a different strategy point of view. You probably heard of data recycling, or you maybe have not. The whole idea is looking at bad debt and good debt, right? So the whole idea is get rid of your bad debt and cycle that into good debt so you can have more investment in that process. Sometimes it's also better to contribute the money to the super fund because it's more tax effective and withdraw the fund to pay off your debt. So there's a lot of consideration of how you can get rid of the debt as quickly as you can. One of the key things coming to the wealth is asset protection. So a lot of people have considered this through family trust. Super fund is actually a special type of trust, and it's protected in such a way bankruptcy can't have creditor taking money away from your super fund. So it's one of the most protected trusts you could ever have. To a lot of business people, this is actually quite important to channel their wealth into the super fund to know that the money once gets there is 100% protected. Family trust is another way to protect the asset. Through the structure, you can put layers in defense against the creditors. Companies limited liability, then you also can rely on insurance to protect yourself from, PI insurance from lawsuits, or personally can insure yourself for income or disability. That's right. Yeah, then that's typically what happens. And also what happens is if you do get all the money into the pension, the super fund, the pension are giving you more money than you require. So those money has to be invested instead of accumulation in the bank account. So it doesn't do anything. The insurance is a big thing. We here think insurance as a cost. It's a cost you should get rid of, right? But the first thing you need to know what's costing you. It's not just your personal insurance, but also the insurance attached to your super fund. And as you increase your wealth and reduce your debt, you should reduce your insurance at the same time. The whole idea is to get you self-insured as quickly as you can. So insurance doesn't become a cost to you, it becomes a source of income to create wealth. But you have to have a strategy to reduce your debt, increase your wealth, and get rid of your insurance. And that's our philosophy towards insurance. Its cost has to be managed. Estate planning, it's really talking about, it's not just about managing your affair well through the will, power of attorney, if you're not able to make a decision yourself and somebody else can take care for you. And estate planning is more looking at how to transition intergenerational wealth transfer, how to pass the asset from yourself, your children or family tax effectively. So that takes a lot of thoughts in how to do that. Normally, in the superannuation fund, it's non-estate asset. So you can make a binding nomination to each other. So that's a quite simple way to just passing money to husband and wife. In that scenario, there's no tax, but they are taxed for the next generation. So there's a lot of strategy to look at how to reduce the taxable so that eventually when your children or family receive them, there will be no tax. Okay, so in summary, I think going to the pre-retirement stage to recognize the fact we're going to live 30 to 40 years, you got to have significant wealth created so you can rely on that to generate income so that you don't run out of the money. And later on, when you go into care facility or services, the cost will go up. Majority of the Australian doesn't have enough. So I think some statistics are suggesting average is 300,000-400,000. So age pension isn't enough money for most of the people to live comfortably. There's a lot of strategy to create the wealth, but the key thing is start early. The early you look at this, the early you take active interest in your wealth, the better you can manage it. You need to be comfortable, understand all the strategies right for you. And the financial planning, what we do is very much goal-based. So it's all about the goal. It's all about what's the final outcome you're looking for. And we put in strategy and plan together to ensure you get there. And how can we help? And so I guess I said this already. That is, we start from understand your situation, and we will identify and clarify the goal for you. Then we will create a plan, whether it be in 5 years or 10 years. Obviously, 10 years is much more feasible and easy to execute and to create something you really want. And we help you to make a decision around how to make investment, not just your super fund. We not really biased in type of super fund we work with. I'm a very few advisors are qualified by Australian super fund. So we deal with retail, we deal with industry fund. We also do self-managed super fund. It all depends on what you like. Yeah, so that's a vehicle to deliver the strategy. And at the end of it, we just want to make sure you work hard for your life. At the end of that process, there's a good, significant nest egg for you to count on, and not just yourself, and also taking care of your family. Going back to the three goals in life, the first one is actually to be debt-free. So make sure you have no mortgage. Second one is secure your financial security. So that make sure you have enough money so you not create a burden to somebody else. The lastly is taking care of your family. So those need to be identified, and you got to put a number to it. So once you have a goal, they help you focus to deliver. That's the process of financial planning. And I don't know any of you have seen a financial planner. You start from having a goal session. The goal session is really help you to have a conversation to get to the number. The number is translated into a targets that become your goal. And from there, we start looking at the information, we start explore, and we also do projections. So what we'll do is we will model the outcome for the next 10 years. Say if it's 10 years to retirement, you want to know what the end picture look like. What's interesting is if you don't know what's the end picture look like, how do you know what you need to do today? So we're making those connections so you know what you need to do today. So at the end of the 10 years or 5 years or whatever the time horizon you look at, you get to that destination. That's our process. Yeah, that's the end of the presentation. Anyone have any questions? Sure. The rental income it's a taxable income. So it depends whether other income adds up to beyond 20,000, so you have to pay tax. Yeah, it depends where you have the property, and you will find the income from property is quite small, especially in Canberra, because they introduced an land tax for investment property, so the cost adds up quite high. But yes, rental income is taxable. Whereas a super fund, say if you got 1.7 million each, that's 3.4, right? For a couple, at 5% income, is what, 170,000 tax-free. And it's so good that you don't have to tell the accountant about it. ATO doesn't want to know either. So you don't do tax return. And also the capital growth is tax-free. Yeah. That's correct. Not just that, your children's going to pay the capital gain tax, right? Because if you pass away, they're going to inherit all the properties. And if they need cash, or if they sell the property, the capital gain they have to pay. Whereas in the super fund, there's a strategy to turn everything to tax-free, right? So for example, if a husband passes the money to a wife in the super fund, that's all tax-free, right? Then subsequently, then goes to your children, and then there's a way of recontribution, there's different strategy, can minimize that tax to not much, basically. Yeah. So there's inherited tax through the capital gain. There's no tax in the super fund, so it's much better. Yeah, you can do both. I'm not. I think you should have property, you should have shares, you should have everything, right? You just don't want to put everything in one basket. Yeah, and another thing I guess I was talking to a client about it is the headache they had with the investment property, right? Every week or months, and there's a repairs, or there's vacancies, there's advertising, and there's just endless tasks coming to you. And if you're lucky enough to have half dozen or so, it's kind of like a job. Any other questions? No, it's so simple. Alyssa, do you have anything to say? Or... Okay, and do we have... Sure.
Sorry, guys, I can't work out how to unmute you. So if you can type into the chat box, I'm trying to reply to a few of those queries as we go. Otherwise, email me and I'll respond to you later on. Gary, you've worked it out. Do you have a question?
No, covered pretty well. Thanks, Melissa.
Oh, that's all right. Just checking.
Yeah, just to unmute if anyone's there, top right-hand corner, the three buttons, and they can select it if anyone does have a question.
Thanks. I wasn't sure whether we blanket muted everybody or whether they were just very nice and had muted themselves.
Yeah.
But all right. Yeah, any other questions? All right. All right. Well, for those of you who are too shy and or just want another drink, you're welcome to join us up the back for, yeah. Aged pensions. Yep. If you have a normal super fund, yeah, you'll be means tested out of a age pension. Well, you still get your seniors card. But yeah, probably depending on how much you earn, the pensioner healthcare card cuts out at a higher rate than the actual age pension from memory. So, so even though you're not eligible for the age pension, you might still be eligible for some of the pharmaceutical benefit type of things. But yeah, our goal is to make sure you're not eligible for anything. You're welcome. All right. Anymore. I've half typed back to you, Harry. If you're an average employee with PSS and you have 10,000 spare cash now and want to contribute to your super fund, do you do it as a concessional or a non-concessional? The trick here is twofold. Well, threefold. One is make sure you're eligible for a concessional contribution. Those the concessional contributions are the ones you get a tax deduction for, so obviously tax effective, but that's tax effective assuming you earn enough. Like we said, it's going to get taxed at 15% going into the fund. If you only earn, for whatever reason, say 25 grand a year, that's effectively below the tax-free threshold. So going and putting 10 grand of that into a super fund is not going to get you a tax deduction because you weren't paying any tax in the first place. So don't waste the 15%, put it into the super fund as a non-concession. And otherwise, watch your contribution caps. So if the boss is already putting in 20 grand, you can't then go and make another 10 grand contribution because you'll be, or concessional contribution, because you'll be 2.5 grand over the cap. So that's where you've got to be very careful and, you know, maybe put a conservative amount into the fund during the year and then just wait until June to see what happened during the year and how much the bosses put in to make sure that you stay underneath that 27,500. Or at least when you're making personal concessional contributions, you actually get to write to the super fund, fill in a form after year end. They kind of write to you to say, well, this is the total contributions we've received. How many are you going to claim a tax deduction for? So this notice of intent to claim means you can then decide after the end of the financial year how much you want to claim a tax deduction for. So you just got to be a little bit careful, and then whatever you don't claim a tax deduction for becomes a non-concessional contribution. Can't put any concessionals, yep. Yeah, so the non-concessional contributions, it's $110,000. It used to be $100,000, but now it's $110,000 per year that you can put into your super fund out of after-tax contributions. So yeah, if you've got money lying around that you've accumulated, saved up during the year, you get to June and you think, well, you know, what do I do with this? Yeah, chuck it in your super fund. I do, subject, not giving personal advice, but the things you need to consider is if you're saving that money in a bank account, you're not even getting 2% on it, are you? 1.5%. Australian Super did 20% last year, okay? And then they only lost 15% in tax, okay? Whereas you earn 1%, 2% interest and then lose 34% in tax. It just doesn't make sense. So yeah, putting it into your super fund is the most tax effective and best investment place to put it. But what you also have to remember is, well, do you need that money for anything else? Because once it goes into your super fund, you can't get it back out until you've met a condition of release. Okay, so lots of things to think about. Yep. No. Okay, so we said, so ignoring the increase this year, the previous few years it's been 25 grand. If, for example, so rule number one is you have to have less than $500,000 in your super fund at 30th of June the year before. Then if that's the case and your boss has, for example, been putting in 15 grand a year for you, then you can top it up by 10 grand a year. And if you've been that short every year for the last few years, when the legislation only got introduced a couple of years ago. So if you were short in 2019 and short in 2020, then in 2021, you could have contributed an extra 20 grand, 10 grand each year on top of your 21 contributions. Now it runs out at, so the system's only just started from 2019, but when we get further down the track, you'll be allowed to go back 5 years. So anything you're short by over the 5 years. And again, you know, the tax planning strategies that we were talking about, if you've got a property that you need to sell, for example, and or shares or whatever else that you're going to incur capital gains tax on, or perhaps you've got a year where you've earned a big bonus from the boss, that kind of stuff. So your income has spiked, then putting money into super and using up some of those unused, you know, carry forward, as we call them, carry forward super contributions from previous years and putting the money into your super fund and claiming a tax deduction to offset the extra income that you've got that year keeps your taxable income low, or at least stops you jumping into the next bracket. You had one more? Contribution rules? An employee of your own company? Yeah. Yeah. Yeah, yep. The concession of 25 grand or 27,500 now, it's across all contributions. So it's your all tax deductible contributions, which means your employer 9.5%, 10%, plus any salary sacrifice, plus any top up that you as a director decide to do for yourself. Maximum of 25 grand, now 27,500. Yeah. Anything above that has anything above that needs to go in as non-concessional. Yeah. Otherwise you'll get hit with an excess contribution tax charge, super charge. Yeah. Better late than never to start. Yes. Thinking about super. Build up super. Yeah. Not capital gains, but there is tax paid to non-dependent children. So adult children who inherit your superannuation account. If there's a tax-free component, which is like your non-concessional contribution money going into the fund, that comes out still tax-free. But if there was any employer super or concessional contributions in the fund, they get paid to your adult kids and they lose 15%. No. Well, they inherit the property tax-free. It just rolls from you to them. But then when they sell it, they have to pay tax on the whole lot from when you bought it all the way through. Well, somebody's got to pay the tax. So if you haven't paid it, they've got to pay it. Okay. After tax contributions, yeah. So most of your fund will be tax-free and it will come out tax-free to even adult beneficiaries. Oh, your super fund will track it for you. On your annual statement, the super fund will tell you how much is taxed and how much is untaxed. And tax-free, sorry. This. Yeah. Wait. Yeah, so when your spouse inherits your super, that still stays tax-free. Or in a worst case scenario, if you've still got dependent kids, they can inherit it tax-free as well. Yeah. Yeah, they're always, yeah. My dad says the first 40 years are the worst. Yeah. Okay. Don't, yeah. I think that's it. All right. All right. We'll let you guys online go. Thank you very much for watching. If you've got any questions or you're too shy to ask today or can't be bothered typing them in, just give me a call tomorrow and we'll run through those with you. But thank you very much for joining us. And for everybody else, yes, you're welcome to stay for a bit longer and have a chat. Okay. Thanks very much, guys. See ya. Sorry? Yeah. Oh, okay. Hang on. If retiring at 60, should I withdraw all money and then put back in as a non-concessional, which, yes, that's Harry, that's a recontribution strategy. And again, it depends. You've all your thresholds and bits and pieces, but yeah, that's definitely still a strategy, a recontribution strategy. Thanks, Jan. Any more? Okay. So